Okay, here we go with lesson 1-2. And here we're talking about classifying accounts as assets, liabilities, or owner's equity, which are three areas we are going to really hammer on here, beginning of our introduction to accounting. And how do they relate to the accounting equation? Assets equals liabilities plus equity. Now, in 1-1, we talk about assets minus liabilities equals personal net worth or net worth. And now we're just kind of flipping that equation slightly on its side and replacing net worth with a business version of ownership called equity. More on that in a moment. We're going to spend a lot of time analyzing the effects of transactions on the accounting equation, on that assets equals liabilities plus equity. And you will hear me say a lot, A equals L plus E, assets equals liabilities plus equity. And then distinguish between cash and on-account transactions. Sometimes we go out and we buy stuff with cash. Oftentimes in business, you don't pay cash up front, you buy it on terms. And we will chat about that as well. All right. So there you go with some of those things. First of all, thinking about the high school. Actually, before we start about thinking about the high school, what are situations in which the same standards or rules are necessary? And in fact, we need to do the same thing every time without fail. Think about where there's no any wiggle room. We must do it according to the rules. No room for your own interpretation or whatever. I would think that handling nuclear waste would be something we want to make sure we follow the standards or rules. That's very necessary. See where I'm going with that? Very important. Where else are standards or rules absolutely necessary? Well, if we didn't have standards or rules in like athletic games, the results of the games and what was penalized and all those kind of things would be very random, right? And the games would be very weird. I just got done listening to the Hawks football game. And if there weren't like standards or rules during the football game, the players wouldn't really know what they could do and what they couldn't do, right? Those are some examples. Pause this for a second and think of your own, okay? Next, what are assets owned by our school? Assets, things of value. I'll let you think about that for a moment, but I'm thinking about looking around my room. I have lights, I have electronics, I have computers, I have file cabinets, I have a data projector, I have whiteboards, I have desks, I have monitors, I have a computer, and I have all kinds of supplies like paper towels back here, a paper towel dispenser. All right, I got a telephone, I got a keyboard, I got this big desk here. Of course, then we get into the walls and the building and the wiring and the piping. There's all kinds of assets, things owned by the school. And somewhere is a list by our business manager of our district, a list of all of these things. I know that last spring, I spent a lot of time putting tags on every single computer and every single monitor in my room so I could keep track of those assets in the future. Okay? So just thinking about what are some assets that we would be using at our school. All right? So we're going to be working with a fictitious company called the Delgado Web Service, and they offer web services to a variety of clients. We kind of dove into this a little bit with a Think Like an Accountant, which is actually kind of slopping over into this week, an exercise. All right. So first of all, thinking about a service business, a business that performs an activity for a fee. Okay. We're not selling a product, we're selling a service. You can make good money doing this, selling a service, your expertise, your training, something you can provide for a customer. Even if it's something as simple as helping someone figure out how to use their cell phone, that would be a service. All right. Next, we talk about a proprietorship. A business owned by one person, we also call that a sole proprietorship. This is probably the most common form of business, all right? And in this case, we would say that the owner is legally responsible for all elements of the business and has total control over the decisions of the company. So, my friend Josh, for example, has his own construction business, and it's him. He's the only employee. He is a sole proprietor. He does all the billing, all the collection. He has all of his tools. It's his business. He's a one-man show, sole proprietorship. Now, why would someone want to own a business as a sole proprietorship? Well, they have total control over all the decisions. They decide what to buy, what to sell, who to sell to, their training, the expenses, where the money goes. They are what we used to use the term chief cook and bottle washer. They do it all. Okay. So there are some definite advantages to being a sole proprietor. Next, we have this term called business plan. And some of you, by the way, I want to challenge you with this statement in that some of you might want to think about true, real life businesses that you could operate and create a business plan for. There's actually a really cool Future Business Leaders of America event, business plan, formal written document that describes the nature of a business and how it will operate. And it is a live, always changing document that you will change over time as your business grows. Marketing, how you handle cash, how you handle credit card payments, on and on and on. What your first year's revenue looks like, money coming to the cash register. What are your expenses? Do you need bank financing? Where's the cash coming from? Lots of stuff in a business plan. So stop the video for a second and think about a local service business here in Walla Walla College Place. Stop, please. Pause. Think about that. All right. Thank you. We're going to come back. So we would have discussed that in class, just thinking about what are local service businesses here in town. All right. Now, again, we're going to do some reading briefly. And by the way, you can always peel back around to your MindTap book and follow up with the chapters and the terms and things like that. But again, whenever we read, in this case, we're reading about the business plan, what are the key themes in the reading? Are there any words you cannot quickly define? And is there something you should include in your notes? Because it always should be in the forefront of your mind. I just check out and go, we're reading. No, focus on that, please. All right. And what we're going to read is the page in lesson 1-2 that describes the business plan for Delgado Web Service. So where I'm at here is lesson 1-2, how business activities change the accounting equation. And I am in week 3, listing of my assignments. And in that, you'll find the reading. There's a little icon for book. All right. So I'm going to click on that. And to give you a little orientation here, when you first pop in here, I'm going to back up here a second. When you first pop in here, you will find you're right here. Starting a proprietorship, changes that affect the accounting equation. Lesson 1-2, how business activities change the accounting equation. We're going to pop over to here, which has our objectives for this lesson. Okay. And next, we are going to go to the Business Delgado Web Service. We just talked about service business, proprietorship, and business plan. But down below, I want you to read this section about Delgado Web Service, because this would be something that we reference and go back to periodically. So read those 4 sections on just the overall plan for Delgado Web Service. Pause the video. Okay. Let's see here. Let's go back to our slide. Hello. Let's go here. All right. Next, we're again talking about standards and rules, things being very tight and controlled. We're going to talk a lot and stay within. This is kind of like staying in your lane. Stay in your lane when you're driving. When you're doing accounting, you're staying in your lane. These things called generally accepted accounting principles or GAAP. And GAAP is what runs the whole world here. GAAP is what we're focused on as far as what are we doing, what's controlling what we do, how are we deciding what makes a transaction or not. So there you go with GAAP. So we're going to keep going back and looking at GAAP periodically. So the accounting equation, we're talking about equities. And before we talked about net worth in section lesson 1.1, financial rights, the assets of a business. So yeah, you own assets, but how much of those assets do you have a claim against as opposed to your creditors? That term I'm going to talk about in a moment here. How much do they have a claim against? Owner's equity, the amount remaining after all the liabilities are subtracted from the assets. So the company has all the assets and somebody has a claim against them, either the creditors or the owners. So owner's equity is what's left over after you subtract the liabilities. That's a part of the company you own, owner's equity. Accounting equation, again, assets equals liabilities plus equity. Show that here. Assets. We're going to talk about double entry accounting as we move forward through chapter 1. But assets is on the left side of the equal sign. Left side amounts are on assets. Right side amounts, liabilities, and owner's equity. Assets equals liabilities plus owner's equity, or if you like, A equals L plus C. So we're going to get into transactions. Transaction, any business activity that changes assets, liabilities, or owner's equity. An account, and when you start out a business, you have to figure out what your accounts are going to be. I got cash, I got furniture, I got computer equipment, I got whatever, all right? Or you might just end up with like a miscellaneous account. So you have to determine what's important. This is true for like doing online banking or doing budgeting. What's important? What do I need to track? What can I just throw into like a miscellaneous equipment category, for example? All right. So an account is where you record all of your transactions. We're going to spend a lot of that time here in 1.2. Account title, a name given to the account. Account balance, after you add or subtract a transaction, what's left is your account balance. And we're going to do a lot of practice on that. The capital account is the account where we track owner's equity and summarize it for the business. That'll be again on the right side of the equation, the capital account. So when we say equity, we're thinking of capital or the owner's interest in the business. So first of all, we're talking about receiving cash. We have this transaction. Whenever we think of receiving cash, that means cash is coming into the company, green stuff. Talked a little bit in lesson 1 about liquidity, or how quickly something can be turned into cash. So cash is coming in. So investment is infusing, putting in $2,000. How would that show up on our transactions with our accounting equation? We start out, everything was zero, beginning balance, 0, 0, 0. We added $2,000 of cash on the left side. We added $2,000 of owner's equity, Michael Delgado capital, that capital account, that's owner's equity. The account title is Michael Delgado Capital. Cash is the account title here. It is an element of assets. Michael Delgado Capital is an element of owner's equity. It's like a subgroup. It's an account under owner's equity. We add $2,000 to each side. We end up with $2,000 cash, and that equals $2,000 of owner's equity. After we get done with the transaction, assets must equal liabilities plus owner's equity every time. Paying cash, we paid cash for supplies. We paid cash for insurance. Here's how that would look. Continuing from our previous example, now we decreased cash by 165. We also added supplies of 165. So the asset side of that equation ends up zeroing itself out. Minus 165 plus 165. Nothing happened on the right side of the equation. You can see that as well when we bought prepaid insurance. Now, you may be buying insurance for like 6 months. We're going to talk later on about the matching principle, but when you buy insurance like for 6 months, you're going to divide it up 1 month at a time, which is, again, that's kind of going to be in the future here. So we subtract $900 of cash. We add $900 prepaid insurance. That is an asset, something of value. They offset each other. After the transaction, you can see here after the cash for supplies, we deduct 165, 2,000 minus 165. We have $1,835 cash, $165 of supplies. That totals $2,000 of assets, which equals the right side of the equation for owner's equity of 2,000. Now, then we buy $900 here. We subtract the 900 of cash. We now have $935 of cash, and we have $900 of prepaid insurance. If we add up 935 plus 165 plus 900, we have $2,000 of assets, which equals our $2,000 of owner's equity. After each transaction, which is the subject of one of our assignments for this particular unit, we should end up with the same equality on the left side and the right side. Yes, we're going to be doing math in here. Creditor is a person to whom a business or a person or a business to whom a liability is owed. So liability is when we owe someone, we bought something from them, we didn't pay for it yet. All right. Now I wanted to find on my screen examples. Just pardon me for a moment here. I wanted to find examples of terms on account. Give me a moment here, please, while I pop this in here. So payment term example. So when we buy something on account, it could look like this. Payment in advance would be, we're like paying cash for that. But net 7, we pay 7 days after the invoice date or after the day we purchase it. You can see the rest of those net. Net 30 is probably the most common where we buy it. We have 30 days to pay that company that sold it to us. So we're buying on terms. Here's another one that's fairly common. 1% 10, net 30. If we pay within 10 days, we pay quickly, we pay faster, we get a 1% discount on what we bought. Otherwise, it's net 30, we pay within 30 days. All right. The other one would be 21 MFI, 21st of the month following invoice date. That might be a little more rare. Okay. But those are common payment terms when a business buys something on account. So here we go. We're buying supplies on account from Canyon Office Supplies. Now we're incurring a liability. We now owe them money after we bought this. We've made a legal obligation to purchase this item. We're so used to buying as individuals. We're so used to buying stuff with cash, like with Amazon, that the thought of buying something on account is a little bit foreign to a lot of people. So this is what it looks like. We added $220 of supplies on the asset side, on the left side. We added $220 to our liabilities because now we owe Canyon Office Supplies. Then, and after, of course, we add this up, 935, 165 plus 220. We have 385 of supplies. We now have 220 of liabilities. If we add up both the left side and the right side after those transactions, we should have $2,200 on the left and the right. Then we paid $100 on account to Canyon Office Supplies on January 9th. We subtract $100 from cash. We subtract $100 from liability because we're reducing the liability by paying it off. We now have 835 plus 385 plus 900. We have 120 plus 2,000. We should now have $2,120 on each side of the equation. The assets, 835 plus 385 plus 900, now equals 2,120. Liabilities plus equity, 120 plus 2,000 is 2,120. All right. So here's some questions. What must be done if a transaction increases the left side of the equation? Well, if we increase the left side of the equation, then we have to increase the right side of the equation, right? Like so. How can a transaction affect only one side of the equation? Well, we saw that when we bought something with cash. If one account is increased, another account on the same side of the equation must be decreased by the same amount. So we saw that when we paid cash for supplies, right? We paid cash for prepaid insurance. We decrease cash, we increase that asset. So we're increasing a supplies account, we're decreasing a cash account. We're still on the left side of the equation, and they end up canceling each other out. What does the term on account mean? Purchasing on account means buying items or services and paying for them at a future date. All right. Now let's get into this. Our lesson 2 assignments, we're going to do terms review, but we're also going to do on your own working papers. I want to go over that now. Plus, I want to get down into this application problem to at least introduce what's going on there. So on your own, let's go take a look at that. There's our reading. So in week 3, September 13th through 19th, I'm going to go to the working papers 1.2. Now, by the way, I've made the the work together assignment 0.1 just because I have to apply some sort of a value to it. Let's work through this for a second. And please pull this up and work through it with me. So here's work together 1.2. And we have 4 different transactions. For each transaction, enter a plus sign in the appropriate column if the account classification, asset, liability, or owner's equity is increased. Enter a minus if it's decreased. Enter a plus and a minus if we have it on the same side, on the left or the right side. So first one is bought supplies on account. Well, I increased assets and I also increased liabilities, correct? How about receive cash from owner as an investment? Well, I received cash and my assets increased and my owner's equity increased. Paid cash for insurance. Well, I increased insurance and I decreased cash in the asset side on the left side. So those 2 transactions cancel each other out. Paid cash on account, I would decrease my cash and I'd be decreasing my liabilities. Okay. So we're practicing that, analyzing, and you'll see I've got posters around the room. Read the transaction, identify the accounts, classify the accounts. Where is the stuff going in those accounts? Is it increasing or decreasing the accounts affected? That's what we mean by classifying. All right, so that is our working papers 1.2 work together. You will then do the on your own 5 questions, same activity. Where do the plus and minuses go for that? All right. Now I want to introduce the last assignment, application problem 1-2.2. Well, by the way, make sure you understand that with terms review, where you do the matching, there's 2 pages to that. Application problem 1.2. Let me open that up. Okay. And here we have, ding, 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 we have 8 transactions. Now, if it helps you and you're in class, I found that if you come back and get a textbook, if you find this irritating, like I keep having to bounce back and forth between the transactions, if you come to the back cupboard and you want to get a copy of the textbook, on page 26 in the textbook is a list of these same transactions. So if you don't like bouncing around here, you can get the textbook and read them and enter them in as you go along. So it says receive cash from owner as an investment. It says transaction one is given as an example. So we received $5,000 of cash on the asset side, the left side. We received $5,000 of equity, Bethany Hartman Capital. That is an account under owner's equity. Okay. When we're done, we rebalance. We now have $5,000 on the left side. We have $5,000 on the right side. Now let's do number two together. Paid cash for insurance, $1,800. Well, I subtracted $1,800 cash. That insurance again. I just lost my track. Yeah. And then we increased insurance $1,800. You can see that only affected the left side of the equation. When we're done with the transaction, we're going to update our accounts. Now we're doing something manually that obviously is being done by computers a lot, right? But when we're done, we have 5,000 minus 1,800. We have $3,200 of cash. I'm just going to put a zero in here for supplies. 1,800 for prepaid insurance. Zero here, and 5,000 here. You can see the left side of my equation, 3,200 plus 1,800 is $5,000. The right side of the equation is 5,000. Every time you rebalance your accounts, make sure the left side adds up to equal the right side for all all 8 of those transactions. The other one's kind of out of view here. There you go. All right. And again, you can use a copy of the textbook on page 26 if you don't want to bounce around. Okay. So we have the on your own working papers. We have terms review. We have an application problem, which is essentially just balancing between assets equals liabilities plus owner's equity and doing some math around that. And then the application problem that I just introduced. All right. And by the way, if you're home and you're like, I'm confused, I'm lost, I need help, drop me a line on Google Hangouts, or maybe we can do a Zoom session or whatever and see how we can help you out. All right. Take care. Happy accounting.